The economy keeps surprising to the upside. We got third quarter GDP of 2.8%, driven by strong consumer spending, up 3.7%. We've seen household incomes, savings revised upwards. Can this strength continue into next year?
I think so. I mean, that's you, in your question, you said it correctly. We continue to be surprised by the resilience of the U.S. economy. 3 or 4 years ago, if you'd said to me, we're going to raise interest rates by 500 plus basis points, I would have thought that would slam the brakes on the U.S. economy. It hasn't. The economy's been remarkably resilient, which is a really good thing. So in the last couple of years, we brought inflation down, not all the way to 2%. We're running at about a 2.5% rate, and the labor market has remained strong. Right now, it looks like that's going to continue. I do a lot of outreach to businesses, large and small, across my part of the country, to labor groups. They all share cautious optimism. And so right now, the fundamentals seem strong, and I'm optimistic that's going to continue.
How do President-elect Donald Trump's proposed policies, from across-the-board tariffs to mass deportations, tax cuts, and deregulation, influence your outlook for the economy, understanding that we don't quite know the exact timing and extent of the implementation of these policies?
Well, there's so much uncertainty about what any new administration is going to do, ultimately what they're going to do in negotiating with Congress. We at the Fed simply have to wait and see. Whatever the Congress and the executive branch decide to do, we will then model it into our analysis of the economy, analysis of the economy's potential and outlook for the labor market and inflation. But until those policies are decided upon, until they become clear, we can't do anything. And so we're just going to wait and see.
On the proposed tariffs, we know that the president-elect has said that he's looking to impose 10% tariffs on all U.S. imports, 60% tariffs on all Chinese imports. If that scenario were to go into effect, what impact would you expect on inflation and supply chains?
Well, on inflation, just step back from those specific proposals and just think about how tariffs work. A tariff, generally speaking, from an inflation perspective, we think of as a one-time increase in prices. So if you have a 1% tariff, you could think of it as a 1% increase in prices of those goods that are subjected to the tariff. That by itself is not inflationary over the long run. It's a one-time change in the price level. Where it becomes complicated is how the other country responds. So if there's a tit-for-tat and an increase in tariffs from the U.S., a response from other countries, and it goes back and forth, then you could imagine a longer-term inflationary impact. And so right now, as I said a moment ago, it's uncertain what the proposal will be, what will get implemented, and then, importantly, how other countries will respond. Right now, we're all just guessing, and so I can't opine one way or the other.
Sure. When it comes to immigration, that has been a big part of the resiliency of the job market the past couple of years. It certainly helped with the labor shortages that we've been seeing. The president-elect has proposed mass deportations. Again, we don't know the extent of this policy, but taken on its face, generally speaking, what impact would you expect on the job market and wages?
Well, if you just start by assuming that the vast majority of immigrants who are here are gainfully employed, then at the extreme, those businesses would lose those workers, and that would provide some form of disruption to those businesses. I ultimately think what will end up getting implemented will be a negotiation between Congress, the executive branch, and business. They will figure out a way to do whatever that they've decided to do, and then we will have to respond. And so I'm not here to opine positive or negative, but ultimately it could have a big effect, but we need to wait and see on what ends up actually happening.
Let me ask you about your outlook for inflation. You said earlier this fall that you weren't too worried about upside risks to inflation. You cited wages and core non-housing services prices that continue to fall. But core PCE, your favorite inflation gauge, has been stuck at 2.7% for 3 months. So how confident are you that inflation is still falling to your 2% target?
Well, we break inflation down by its subcomponents. So goods inflation is running roughly back where it was pre-pandemic to slightly disinflationary levels. If you look at other parts of services inflation, they're tied to wages. Wage growth is slowly cooling. Housing inflation is the big elephant that is still out there. And if you look at where new leases are, new lease inflation has already fallen back down to very low levels. But new leases take a couple years to work their way through into the broader measures of housing inflation. So, I don't want to declare victory too early, but I think there's pretty good reason that we have confidence that the housing piece of this will slowly return back down to more normal levels. Ultimately, we're going to get back down to 2% inflation. It may take a year or two to get all the way there, given some of these housing dynamics, but the trends so far are encouraging.
What about the job market? We've seen a lot of volatility in those monthly jobs reports. The October report slammed by those two hurricanes, the Boeing workers' strike. How are you looking at the labor market now?
Well, the labor market, as we mentioned a few minutes ago, has been surprisingly resilient. A 4.1% unemployment rate. It's a good labor market. When I meet with, again, not just businesses, but also labor groups around my region, it's one of cautious optimism. I mean, a bunch of labor unions that I've met with recently have said that they're feeling confident enough that they're going to have some actions taking place, meaning they're preparing to strike. They're feeling like they're in a strong position. Usually I don't hear labor unions talking about that if they're feeling like the pendulum has swung away from labor. So most of the dimensions that we look at, the labor market is still strong. It is not as red hot as it was a year or two ago, but the fundamentals are still sound. And so that's encouraging to me that the labor market looks robust and consumer spending continues to surprise us. Consumers continue to be resilient. The fact that the savings rate has been revised up is also encouraging, suggesting that consumers on average are not getting overextended. So right now the economy looks like it's in a strong position.
So then what does that mean for the rate cutting path forward? You said earlier this week that another rate cut in December is certainly possible. What would make a rate cut not possible in December?
Well, I think if we saw inflation surprises to the upside between now and then, that might give us pause. If the labor market, it'd be hard to imagine the labor market really heats up between now and December. There's just not that much time. I think there'd have to be a surprise on the inflation front to change the outlook so dramatically. The bigger question long run is, where are we going to settle? What does neutral represent? One big surprise over the past couple of years, if the economy has been more resilient than I expected in the face of this high policy rate, how do you answer that question? Why has that been the case? The answer that I'm taking away is maybe the neutral environment, the neutral rate environment has gone up, at least in the short run. Now, how long is that higher neutral rate environment going to persist? I don't know. A helpful data point over the last couple of years is productivity looks like it's been stronger. If productivity is going to continue to be strong, all else being equal, that would relate to me to be a higher neutral environment. Think about what sets the neutral environment. It's the balance between savings and investment. And if the productivity environment of the U.S. economy is higher, all else being equal, there should be more demand for investment capital to fund those productive investments. So in a higher productivity environment, the neutral rate ought to be higher. And so if we are in a structurally higher productivity environment, that would tell me we have less room to cut until we eventually get back to neutral. I'm not saying we're very close to neutral right now, but when we think about the destination, we may not go down as far.
So given what you just said, we know the consensus of the FOMC is for 4 more rate cuts next year. Given the strength of the economy that you expect it can continue, given your comments just now on neutral, do you see fewer than 4 rate cuts next year?
We have to see what the data says. I mean, ultimately, the data, one thing that Chairman Powell says is the neutral rate is not directly observable. We know it by its effect on the economy. And so we're going to continue to monitor the labor market, inflation, GDP, spending, to try to ferret out how close are we coming to neutral. I think we all agree we are above neutral now. But over the course of the next year, we're going to get a lot more information about where neutral is. And we're also going to be looking at market signals in terms of the real yield curve. Where is the long end of the real yield curve? That's giving us some feedback as well.
Let's get to the yield curve in a minute, but I'm curious whether Donald Trump's election changes the terminal rate forecast for you.
We have to wait and see. We have to wait and see what ultimately gets enacted by the Congress and by the executive branch before we determine anything. Obviously, the long end of the yield curve has moved a lot since we started cutting rates, 6-8 weeks ago. The long end of the curve has moved a lot. It doesn't look like that is in long-term inflation expectations. There's been some move in short-run inflation expectations, but long-run inflation expectations do appear to be well anchored. Could that be a view of that productivity is higher and the neutral rate is higher? That's probably part of it. Some people have speculated that maybe there's expectations about more deficits to come. We'll have to see. There are a bunch of different components in there that we need to try to strip out to understand what markets are telling us. And the thing that gets complicated for us is that we look at markets, but a lot of times markets are looking at us. So it's a little bit like we're looking in the mirror. So trying to ferret out what is a real signal and what is just a reflexive signal, it's an inexact science.
How restrictive do you think you are right now?
I would say, in my judgment, I think we're modestly restrictive. Just by the virtue of the fact that we went up to 5.25% and the job market remained as resilient, that tells me we could not have been very, very restrictive. So instead of, while I thought we were putting 2 feet on the brakes, I think in hindsight we were probably only putting 1 foot on the brakes. And what's really difficult about this is this notion of a neutral rate. It appears to be time varying. So yes, the neutral rate has been elevated in recent months or the last couple of years. How long is it going to stay there? We're not sure.
You mentioned the yield curve, the yield on the 10-year Treasury up better than 70 basis points since you first started cutting, and you've actually cut by 75 basis points. So how does that complicate your job if this persists? And where do you see the yield on the 10-year going?
Well, it complicates it. Trying to assess, this conversation we're having is a lot about trying to assess how restrictive is the stance of monetary policy. And I always think that there's 4 components, 4 instruments that we have in monetary policy. There's the federal funds rate, there's the expected path of the federal funds rate, there's the balance sheet, and the expected path of the balance sheet. All 4 of those are individual tools that go together that represent the stance of monetary policy. And I look at the long end of the real yield curve, so say 10-year tips, as a proxy that puts all of those components together. 10-year tips today is something around 2%. Prior to the pandemic, it was roughly around 0, which at that time I thought was roughly a neutral stance. In the middle of the pandemic, with all the stimulus, we drove it down to -1. It then went up to about +2.5 and is now running at around a 2% level. So right now at a 2% real tips rate at the 10-year, the economy is still performing pretty well. And so, we're going to need to watch and see. Again, it goes back to, are we in a higher productivity environment? Are we in a higher structural growth environment? Can the economy grow with this type of real yields? We're going to have to see, and it's going to ultimately be a judgment call as we take in the new data and adjust our policies in response.
The trajectory of debt is not a good one. We're close to 100% of debt to GDP, and it's rising. It's expected to continue rising under the new administration and would have under Harris if she were elected as well. I'm curious, does the trajectory of put the discipline of fiscal policy to rein it in, or does the central bank feel pressure to try to offset that trajectory as far as long-term rates?
Well, first, if you look at the Congressional Budget Office's forecasts of the debt over the next 20 years, it goes to the moon. It grows unsustainably. And that obviously cannot happen. So ultimately, Congress and the executive branch will need to work together to come up with some kind of a plan to address that. Our job is not to comment on that, not to opine on it, not to offer suggestions on what they do. That's up to them. Our job is to achieve 2% inflation. And that's what we're going to do. And so we're going to do what we need to do to achieve the dual mandate goals that Congress has given us, given the rest of the macro environment that we are recipients of. And that fiscal path is part of the macro environment that we are recipients of. And so that's going to be the job of Treasury and the Congress to sort out. And we will do what we need to do to achieve our dual mandate goals.
If you get too much volatility in the Treasury market, would you stop the balance sheet runoff?
I think for me, the bar of stopping the balance sheet runoff would be quite high. I mean, we've done it in the past. In the last time, when 2019, when we were shrinking our balance sheet, we were the only central bank in the world shrinking their balance sheet after the great financial crisis. And then we were draining reserves out of the banking system. We had, I think, underestimated how many reserves the banks were going to require. And you ended up seeing volatility in the Treasury market and in the federal funds rate. And then we stepped in and intervened at that point. I think we've gotten better, and we're going to be able to avoid that this time. But my judgment is we still have a ways to go before the Fed is done shrinking our balance sheet.
So if there is a lot of volatility, to be clear, would you intervene in the market?
It'll depend on how extreme the volatility is. Ultimately, financial stability is part of our mandate, and financial stability is the Treasury market is part of that. But I think the bar for me would be quite high before we would change our path.
If President-elect Trump tries to pressure the Fed to lower rates, and the Fed doesn't feel that that is the correct course of action, how would the Fed respond?
My colleagues and I are totally committed to achieving the goals that Congress has assigned us: maximum employment and 2% inflation, and we're going to conduct monetary policy to achieve that. And the thing is, The Federal Reserve was designed by Congress in 1913 with specific institutional structures in place to provide continuity. So the governors in Washington get up to 14-year terms. 14 years, it's a long time. That provides continuity. The 12 Reserve Bank presidents are independently appointed. That also provides continuity. And so I'm confident that we will continue to focus on achieving our economic goals and not responding to whatever pressures might be coming from Washington.
If the president-elect tries to push out Fed Chair Jay Powell, what will the FOMC do? Would the FOMC try to rally around to keep him in place?
I'm going to defer. The chairman answered this question last week in his press conference, and I'm going to defer to his comments there. I don't have anything to add to that.
All right. I want to circle back to tariffs for a second, because the last time Trump was in office, he had slapped tariffs on China. And in that environment, granted, it was a different economic environment. We saw slowing growth, but you guys were lowering rates. And there's a common belief that tariffs could be inflationary and therefore interest rates could go up. So my question to you is that necessarily the case given what we've seen just some 6 years ago?
Well, we were talking about a few minutes ago, I think the analysis of a one-time tariff is pretty clear that that's just a step change in the price level. People will pay higher prices, but that doesn't mean inflation is higher going forward. The real question is the tit-for-tat between countries. If they go back and forth, escalating tariffs on each other, that could lead to a longer-term inflationary dynamic that we'd have to consider at that point. So I really think it's going to depend on the dynamics of what's happening as opposed to just this hypothetical.
If you did see more inflationary dynamics, would that cause you to consider hiking rates, or would you be looking more towards a lengthy pause?
It's going to depend on so many different things. I mean, ultimately, we have our goals, maximum employment and stable prices, and we're committed to achieving them, and we will use the tools that we have to achieve them.
Any last thoughts when it comes to the trajectory for monetary policy as we get to December and next year?
I would just say the U.S. economy is in a good place. We've cut interest rates by 75 basis points to try to bring it back down closer to a neutral environment. We're not at neutral yet. We're still in my judgment, we're still at a modestly contractionary stance. But ultimately, the economy will guide us in terms of how far we end up needing to go. The labor market is strong. We want to keep it strong, but we need to get inflation all the way back down to 2%. And I'm confident we can do that.
Neel, thank you so much for your insight. So appreciate you being here today.
Thanks for having me.